What's going on? Today we have a great topic trying to tell if we are heading for another real estate crash. CoreLogic just came out with their new monthly report breaking down delinquent mortgages, and there is some staggering information in here which I am very concerned about, and we really have to dig in more to see if it's going to affect you. To better understand everything, we have to define something really quickly. A delinquent mortgage is when somebody does not pay their mortgage on time, and once you are more than 30 days past due, your mortgage is instantly classified as some form of a delinquency because of your failure to pay. These levels are tracked on a national basis and can be a leading indicator for potential future foreclosures. In 2009, this article by CNN Money breaks down that delinquent mortgages were 9.64% nationally. And today, according to CoreLogic, we are only at 7.1%, and that number is rising and getting closer to those 2008 and 2009 levels. To better understand this, let's jump into the CoreLogic article and see how they break down delinquent mortgages. CoreLogic has a phenomenal chart breaking down the various stages of mortgage delinquencies, depending on how many days past due you are on your mortgage. Once you are more than 30 days past due, you enter into some form of a delinquent stage. And currently today, if you total all the mortgages that are 30 days or more past due, we are at 7.1%, which is merely only 2.5% off of our 2009 delinquent mortgage levels. We were actually on a phenomenal trajectory of declining mortgage delinquencies. Only a year ago today, we were at 4%, and today at that 7.1% level. Another interesting chart in the CoreLogic report is a breakdown by metro market. As you can see here, some of the major metro markets like mine in Boston, Las Vegas, New York, and New Jersey are all either double or triple their delinquent levels that they were at only a year ago. This is a very concerning leading indicator that there could be trouble ahead for many homeowners. So what is something that we can do about this to plan for the future? First, it really depends what submarket you are in. I'm in the Metro West market, and it is a really competitive market. There are way more buyers in the market than sellers. Many homeowners have a lot of equity in their property, and we're not going to see a lot of foreclosures in this higher priced Metro West market. A lot of it is going to depend on what happens in Washington. Many of the current headlines have been showing that the Democrats and Republicans are failing to reach any agreement on a phase 2 or phase 3 stimulus package, and we are unlikely to see anything happen until after the election. If we don't see the government step in, I foresee delinquency levels rising beyond the 2008 and 2009 level, and it could be a potential issue going forward. If we see delinquencies rise, there will be more foreclosures, and depending on which market you are looking in, there will be a lot of foreclosures hitting the market. Areas where properties have not seen as high of appreciation, like in my greater Boston area market, will be more susceptible to having foreclosures. If you are looking to purchase a home, be on the lookout for opportunities in deals depending on how these economic factors change over time. We will be tracking these mortgage delinquency levels to see if there's any opportunity of a foreclosure market and which metro markets there could be an opportunity for you to purchase in.